day, welcome. This is the Investor Coaching Show. Paul Winkler, along with Mr. Jim Wood, talking money and investing. Looking here, Jim, I got somebody asked a question. There it is. Okay. We got enough material to last us weeks today, don't we?
We're going 10 hours straight.
Well,
maybe not.
No. We're not going to go 10 hours straight. That ain't happening. Is it an old producer? One of my old producers actually asked a question. So Matt was one of my producers of the radio show in the early years, and he actually asked a question about an article that was in Morningstar. Now, what on earth, Matt, are you doing reading Morningstar? That's like an industry publication. He's showing his advanced self. See, that's what happens when you're producer of this show. Leviticus, listen up, man. No, he's that way too. The one thing I loved about this station is that everybody has been so engaged. I can't think of anybody that was a producer of this radio show that wasn't super engaged in the show and listening every week. That's just cool.
Well, it's great when you get a little bit of knowledge about something and it piques your curiosity, and you're just like, well, this makes sense, and I want to know more about that, and you build upon your knowledge. You start layering that foundation, and bit by bit, you add to your knowledge, and it just becomes more and more interesting.
It really does. And some people, it's just never going to be interesting to them. You just got to face it. And we're not all built the same. That's thank God we're not all built the same.
Thank goodness.
That would be a real problem. But anyway, so the thing that was written about in Morningstar was this about 60-40 portfolio. So you have different investment designs. So the first factor that you focus on when you're putting together an investment portfolio is how much do I have in stocks versus how much do I put in bonds? And that's the first factor. Another factor you look at is small companies versus large companies, then value versus growth. And other factors are going to be more expense related. For example, momentum would be another factor that you might look at. And then you have the issue of profitability factor and other things like that. They're not as important, but very most important one is how much in stocks versus bonds. And that's your starting point. And that will be driven by time horizon. So if I've got a long, long time, I got a long, long time. I'm Methuselah. No, not quite that long. Then you basically can be all equities. If I'm looking at a long time before I use money. Then if you're getting close to retirement, you might go somewhere in the neighborhood of about 70%, 75% stocks as you're 10 to 15 years before retirement. That's just an example. It just depends on the person. Because sometimes you'll have a situation where your time horizon may be significantly shortened due to maybe your health. It could be that your situation with your job, you're working in a career field that could be shortened based on back issues, bodily breakdown issues, those types of things. So that varies. Don't take anything like that I say as going, it's always this way. That's what Paul said. No. Then you get closer to retirement and you're going to be physically taking an income. You might be, usually 50% is the minimum on stocks when you're taking an income. And you can go up from there depending on how much income you're taking and what your level of flexibility is. So 60-40 is a very typical pension mix. And they're saying here that, why did the 60-40 balanced portfolio, why it isn't working in 2022? He said, his question was, can you elaborate and explain the validity of this article? Yeah, Matt, I think the headline just bugs the tar out of me. I mean, right? It's not working. And the idea is that, it failed. And, this is, it's a new paradigm. We're in a new situation. Things are all different now. No, 60-40 portfolios, if properly designed, will take into account type of things that are happening right now. And what they're really referring to here is the idea that if interest rates go up, then stock prices go down. or can go down. Not always, can go down. So why would that be? Well, if companies have a lot of borrowed money, then their cost of doing business has gone up, and that can hurt profitability short run because that takes away from their earnings. The other thing is, of course, people borrowing to buy stuff. We've been hearing this recently. Matter of fact, we did the show last week, and my current producer, Leviticus, made a comment about 10:30 that night. Yes, he was texting me at 10:30.
He is engaged.
No joke. It was something to the effect that, you know, what you and Ira were talking about last week is exactly what happened, he said. And I sent it to Ira, and he goes, well, at least people realize it's relevant. The show's relevant. and I laughed, and I said, yeah, you know, we were talking about real estate. And he says, literally, it was all in the news after the show was over. That the real estate things that we were talking about were that were actually coming to fruition. And part of that is because if interest rates go up, then it reduces the demand for real estate. It reduces the demand for cars. It reduces the demand for, anything you might think of that people would borrow money for to buy. So hence, you can have an economic downturn. The other thing that you have that happens is, of course, interest rates going up. And if interest rates go up, what happens is that existing bonds will actually drop in price, right?
Absolutely. And then the longer term of the bond, the more drastic the drop's going to be. So you get your, 20 and 30-year bonds, they're going to take an enormous hit from not really a big rise in interest rates.
Right. And that's something we ought to talk about because Scott in the Goodlettsville office actually had done some really interesting research. And sometimes I said, hey, go forth and do. I love having people around us.
You like to say go forth?
I love having people around us that are just like, hey, you can tell them to go do research and they know what to look for. It's so cool because he'd been a listener to the show for such a long time before he ended up working with us. But anyway, I just think that's so cool. Anyway, it's a point of great pride for me that we got people, just phenomenal people around us. But anyway, so back to this, if interest rates go up, and yes, it's even more dramatic if you have longer term bonds, and hence the reason that we tend to keep the bond maturities shorter. We don't go in 10-year, 20-year bonds, 30-year bonds. You can get a higher yield. And that is so often what gets people all confused is they think, well, I'm here to get return in my investments, right? No, you can't ignore correlation. You can't ignore how things move with each other and against each other. So that is why we want to keep the maturity shorter, is because we don't want these big movements of stocks and bonds together. But you can't avoid it if you're going to even have intermediate maturity bonds. And that's in essence what happened this year, is you had that happen this year where both of them went down together. And what's happening is people go and say, well, okay, then as they're saying in this article, the 60-40 portfolio didn't work. No, wait a minute. You miss one of the things, one of the elements in a 60-40 portfolio that was fine, which is cash. And, prior to this year, I would get people to call me up and say, they would say, Paul, you recommended that I put this much in cash in my 401k. You recommended that I hold this much in cash in my IRA or in my non-qualified account or blah, 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 whatever account that they had. Why so much cash? I mean, the interest rates are just about nothing. And I would go, yeah, the purpose of the cash is not return. I mean, you pretty much guarantee you're going to lose money after inflation. But the key is that when stocks go down, and if stocks, not when, I mean, they will go down, and if bonds go down with them, you have to have something you can pull income from. And hence the reason that we have cash in the portfolio.
Well, the whole title of this, the 60-40 doesn't work anymore. Well, there's so much into that is just wrong in terms of who says it didn't work. Who says the 60-40? Maybe bonds did go down.
Yeah.
Whether you have, short-term, long-term, midterm, we keep ours, like you said, very short. And so that did not go down nearly as much as stocks. So it did its job. It reduced some of the volatility. And that's what it's there. It's typically it goes up when stocks go down, not all the time because of rising interest rates and all that, but it still provided diversification benefits in that it did not go down as much.
Yeah, and cash actually held its own. It didn't go down at all.
Right.
And that is the key. That's something that I always teach at our initial workshops. One of the keys to know whether your investment portfolio worked the way it should is, did everything go down together? And if it did, yes, that would be a failure. Or do you have something in any given year? Do you have something that held value? If you had something that held value, then by definition, it worked. And that's really the key. So that's what happened. So number one, that's the first thing. So if something held value, you're fine. Now, cash held value. And it would be foolhardy to think that stocks and bonds couldn't go down together. It would be foolhardy to hold any cash in the portfolio whatsoever if that couldn't happen. And you always look at what can happen when you're designing an investment portfolio and recognize that what happened this year could happen. And it does when you have that situation where interest rates go up dramatically in a short period of time. People borrow less to buy stuff. They can't buy enough stuff, or they can't buy things that they used to buy, or they'll reduce their demand for those things. And then that will drive stocks down. But here's the thing about bonds, the other part about those bonds as well. When you keep the maturities a little bit shorter, that decline in bonds tends to be very, very short-lived. And what happens is that you'll actually have a higher yield to maturity with those bonds when those bonds go down in value. So actually they worked quite well. The 60-40 portfolio worked quite well. Now, here's the thing that I hear from time to time from people, and maybe we'll spend a little bit more time on this, is that, the rule on how much income you can take from an investment portfolio, heard this recently, somebody said this on the radio, and that rule doesn't work anymore. And I would absolutely have to agree with them. It didn't work because of the way that Wall Street investment firms typically manage money. They typically chase returns, they stock pick, they market time, they use tactical asset allocation, they use long-term bonds in their investment portfolios, they overweight large U.S. stocks. They do all of the things that for over 20 years on this show, I've said, don't do that. And then what happened is then they go, oh, that rule of taking income from your portfolio doesn't work anymore. No, it doesn't work if you don't follow the dictates of the study that was done on how much income you can take from an investment portfolio. Not that this bothers me at all. Not that I don't need to go do deep breathing exercises right now after that. But it just makes me crazy how you get stuff out there like that and be like, oh, it doesn't work. Everything's different now. And I think that's the key to it, Jim, for me, is that premise that it's all different now. It's always different.
Well, I think people, I think so much of financial journalism comes from the point of, okay, this headline sounds really neat. I'm going to write an article to go along with this headline.
Yeah, very true. Yeah, very true. It's like, what can we do to really shake things up, regardless of whether there's any truth behind it or whether it's helpful or not? Let's write something to shake people up. And then on the other side, then you have the investment industry takes an article like that, and they go, see, it's because they're trying to sell something, and it backs what they're trying to sell. And then what they don't recognize a lot of times, because they don't really analyze the data very well, as we'll talk about, because I get a couple things that are really want to spend some time talking about, but they don't analyze the data and they come to the wrong conclusions because they're actually looking for what they need to sell and we call that confirmation bias. We look for things that tend to back what it is, the conclusion that we would like to draw for whatever reason. So we tend to do that as investors, but the sales community also does it, which makes it so difficult for the end investor.
And the thing about the 4% rule, too, is that's a place to start the conversation. That doesn't mean everybody out there should take 4%.
Right.
It's just a place, that, kind of a number they came up with when they did the initial study. So everybody kind of talks about that number. But everybody's different in terms of, what are their savings? What are their needs? Those types of things. So it's really a place to start talking about the the situation, and we have some phenomenal software in terms
Right.
of helping people figure out what is the right amount to take income from, in terms of it being a dynamic process, meaning as long as you can be a little flexible, if markets go up, you can take a little more.
You can take even more than that. Yeah, that's exactly right. So that number, that 4%, was the amount that you could take going back and using data from the year 1900. So, of course, you're actually looking at the Great Depression, World War II, Korean War, Vietnam War. You're looking at, everything that has happened, oil crisis, all of the things that have happened, real estate crashes, tech crashes, everything that has happened. And that's what William Bengen, the gentleman that did the research on this, that's what he was looking for. What level of stocks versus bonds do I need in order to take an income? What gives me the optimal ability to protect myself from inflation for at least a 30-year period?
Now, I wish I could remember the study, but there was one that looked at the 4% rule going through, the crash of 2008, and turned out, things, were unpleasant for 15 months, like they were for everybody.
Right.
But ultimately, that person did fine.
Yeah,
looking
that's
at
interesting.
That portfolio. I wish I had something to cite on that.
Well, we have it in some of the things that we've done, for our clients that we've done workshops on that particular topic even. And it worked just fine during that period of time. So, the reality of it was, and, just as far as where that data is and that if you're a client of ours, we can direct you to that, where we actually went through that whole process. But and there have been studies out there. It'd be kind of neat to find, where somebody else other than ourselves actually showed that was the case. So, but anyway, but we hear that and just recognize that so often what happens as investors, people are being sold things and not necessarily with all of the real facts being used in order to help sell investment product. Be very, very careful. That is why I spend so much time, and we spend so much time right here on this show educating, because I believe the educated investor is not easily misled.